Real talk. You've been lied to. Not by some shadowy conspiracy, just the general vibe of the internet. The idea that tax breaks are reserved for billionaires, hedge funds, and people who own yachts they can somehow write off as a business expense. Here's the truth. The tax code is loaded with tools specifically designed for people like you, middle class, working hard, building something. And most of you are leaving thousands of dollars on the table every single year because nobody told you these existed. Here's the mindset shift I want you to walk away with today. Revenue is vanity. Profit is sanity. But what you keep after taxes is what actually builds wealth. 5 strategies, all legal, all available to you right now. Let's go. Cheat code number 1. And this one genuinely makes people's brains short circuit when they hear it. The HSA, or Health Savings Account, is the only account in existence where the IRS cannot touch your money coming in, growing, or going out. That is a triple tax advantage, and it exists right now for you if you're enrolled in a high-deductible health plan. Here's how most people use it. They swipe the HSA card at the pharmacy, feel responsible, and move on. That is the financial equivalent of buying a Ferrari and only using it to go to the grocery store. Here's what you should actually be doing. Say you have a $2,000 surgery this year. Instead of paying with your HSA, you pay out of pocket from your checking account. You take that receipt, digital, PDF, folder on your desktop, whatever, and you file it. Then your $2,000 stays inside your HSA, invested in a low-cost index fund, compounding at 7% annually. 20 years later, that $2,000 is worth over $7,700. And here's the kicker. You can reimburse yourself right now for that 2025 surgery. The IRS has no expiration date on reimbursements, so you just pulled out $7,700 completely tax-free on a receipt from 2 decades ago. That's not a loophole. That's just the rules for people who actually read them. Okay. Raise your hand if you've had a stock go completely sideways on you this year. Keep it up because I'm about to tell you that loss might actually be your biggest tax asset. This is called tax loss harvesting, and this is the world's worst kept secret in finance that somehow most people still don't know about. Here's how it works. Say you bought Airbnb stock and it's down $4,000. Meanwhile, your Nvidia position crushed it. You're up $4,000. If you sell both, those gains and losses cancel out. Your taxable gain? 0. But it gets better. What if you have more losses than gains? The IRS lets you deduct up to $3,000 of those excess losses directly against your ordinary income, your W-2, your salary, whatever you earn. And if your losses exceed even that, you carry them forward to next year and the year after until they're used up. Now, and this is critical, do not immediately rebuy the stock you just sold. That triggers something called the wash sale rule. If you sell a stock at a loss and buy it back within 30 days, the IRS disallows the deduction, completely wipes it out. The workaround? Swap into a similar but not identical ETF. Sell your airline stock, buy a broader travel ETF. You stay in the market, you keep the tax deduction, and you play by the rules. That's the move. Cheat code number 3, and this one has a branding problem because the moment people hear 529, they think it's only relevant if you have a kid heading to Harvard. Wrong. A 529 is a tax-advantaged investment account for education expenses. Contributions aren't federally deductible, but over 30 states offer a state income tax deduction or credit. And every dollar inside that account grows completely tax-free, as long as it's used for qualified education expenses. Now, here's where it gets interesting. What if your kid gets a scholarship? What if they skip college entirely and go learn a trade? You have options. You can roll the funds to a sibling. You can keep it for a grandchild. You can even roll up to $35,000 into a Roth IRA for the beneficiary, penalty-free under the new Secure 2.0 rules. Or, and this is the one people sleep on, you can use it for yourself. Continuing education, professional certifications, graduate school at 45. The 529 doesn't care how old the student is. This is a lifelong learning shield with a tax advantage baked in, and most middle-class families are either not using it or dramatically underusing it. Cheat code number 4. This one is less sexy but potentially worth thousands. It comes down to one question. Are you itemizing your deductions or just taking the standard deduction because that's what your tax software defaults to? Here's the math. In 2025, the standard deduction for married filing jointly is $31,500. That means if your total deductible expenses, mortgage interest, property taxes, charitable contributions, state and local taxes, add up to less than that threshold, you're taking the standard deduction. Fine. But if you're a homeowner with a meaningful mortgage, paying property taxes, and making charitable donations, run the numbers. Because if your itemized total exceeds $31,500, every dollar above that threshold is reducing your taxable income, dollar for dollar. The mistake most people make is they assume their tax software or their accountant is already catching this. Sometimes they are, sometimes they're not. The number of middle-class homeowners who are defaulting to the standard deduction when they could be itemizing and saving real money is genuinely painful to think about. Check your last return. Add up your actual deductible expenses. If you're within striking distance of that threshold, a slightly larger charitable donation before December 31st might push you over and save you more than the donation costs. Here's the big picture takeaway. None of these strategies are dramatic on their own in year one, but this is what nobody tells you about tax optimization. It compounds. Save an extra $2,000 in taxes this year. Invest it. Do that every year for 30 years at a 7% return. That's not a rounding error. That's over $188,000 in additional wealth built entirely from money you were already earning and simply chose to keep. The 1% aren't smarter than you. They just have people in their corner who know these rules. Now you do too. Here's your action plan for this week. 2 things only. 1. Check if your health insurance plan qualifies as an HDHP. If it does, you are eligible for an HSA. Open one. Move the balance into an index fund. Start keeping your medical receipts. 2. Start tracking your net worth, not just your income, because the goal isn't to earn more. The goal is to keep more, grow more, and watch the gap between what the IRS takes and what you build get wider every single year. If this video gave you one new idea, hit the like button. It helps more people find this content. And if you want the full breakdown on how to build a completely tax-optimized investment strategy, let me know in the comments section.